This morning we're here at the offices of Austin James, and I'd just like to tell you a little bit about the business and what our core beliefs are. The company was formed on the basis that when people are making important decisions in the run-up to retirement, they have to really take a step back, reassess their position before they can move forward. And we call that moving from risk to safety, and it's what our business is built upon.
I want to talk about the phrase, the market myth. What do you mean by that when you...
Well, there are lots of market myths out there, and really I'm here to explode some of those. The first one is that most people that invest other people's money believe in what I call the cult of the equity. The stock market is always right, and that if your money goes down, take the pain, don't worry, the market will go back up at some point. That's great for a certain sector of the population because younger people can afford to ride out the peaks and the troughs and the roller coaster and that sort of thing.
As we've discussed before,
But for clients who are approaching their retirement window, really it's a bit arrogant for other banks and sort of the financial industry to say, oh, don't worry about it, you'll be all right. Because if they'd have said that 10 years ago, really the market where we're sitting today hasn't really grown very much in the last 10 years, it's just zigzagged. So this market myth that equities always, or shares always do well, doesn't always work. So that's the first myth that needs to be shattered. Okay. And that, just because your money's gone down, should you just leave it where it is, or should you review it? Well, my view is that you should review it.
Can we talk specifically about the technology sort of boom back in the early 2000s?
Yeah.
You mentioned that people lost a lot of money then,
yeah,
but maybe stuck with it thinking, well, look, we'll make it back, and they still haven't.
This is the thing about human psychology when it comes to investing, is that when you have lost some money, your brain says, stay put, it's just inertia. And the wider financial industry plays upon that. They actually make people fearful. And in the newspapers it might say, you've lost some money, don't do anything. Okay, that's fine. What happens if the market goes down by another 5%? Do you still stay put and do nothing? What then happens if the market goes down by another 10%? Do you still stay put and do nothing? Do you see what I mean? It's kind of this catch-all myth, because everybody has a personal time horizon.
Yeah.
Now, for people who are younger, their time horizon is way off. They can afford to take some of the heat, when the market goes down. For people coming up to making important retirement decisions, they haven't got as much time. And we use this analogy of, when you're playing golf, you can hack around the fairways and zigzag around like the stock market does. But once you get onto the green and you're just doing your putt into the hole, you've got to be a bit more stable and a bit more steady. And that either means that you've got to take some preventative action as you approach that time, or if you haven't, you do need to review things, because the stuff that you're in that's gone down might not be the stuff that recovers in the next few years. In fact, that's quite a long-winded answer to your question, but coming back to the technology side, there are a lot of people that we come across that 10 years ago put their money into technology because it was the in thing to do. Yeah. They then lost, 50% of their money in the crash of, say, 2001 to 2003. Yeah. But they never reviewed it. So they were just thinking automatically that if I leave it there long enough,
it will gradually
I'm going to make my money back. Well, it hasn't.
So if I'd have done that back then, when I was, say, 45, I'd be now approaching 55 and looking to...
You'd still be nursing. If you were in that sector, you would... Because don't forget, that's the other thing. When you're younger, you're prepared to take more risk.
Exactly.
So, at 45, you're thinking, hey, I'm going to have a bit of technology and all that kind of stuff. And now you're 10 years later and you're thinking, well, hey, I'm going to have to be a bit more cautious now. But actually, you haven't made your money back. And in fact, over that time frame, you would have needed to have been in other asset classes and review it, because nothing stays the same forever these days. And that's really what I'm saying moving forward. One thing actually which was a big shock to me, and again this was in the Financial Times a couple of weeks ago, was that 70% of the American stock market trading volume is now what we call automated high-frequency trading. So it's not even human beings that are making these decisions. 70% of
How
the stock
can that
market in
happen?
America, well, it's how the market works.
Really?
So, you know, when the market goes down, it's not people making decisions to mark the market down, it's actually computerized programs that make the market go down.
That's just horrific.
So that's why you have a much more apart from, you know, there are obviously some dangers and economic things out there at the moment, but that's why you have a much greater volatility in markets than you ever used to. And that's going to continue. So that's why you need to be with someone that's going to review things and keep you on track.